Hey traders, this is Blake Morrow with Trader Summit. And I have Mr. Jim Welsh with us once again today. Hey Jim, how are you? Good to see you.
I'm good, and it's a Friday.
It is a Friday, and we've got. I was thinking the rally that you'd been expecting. We broke above 4,200 in the S&P. It really looked like we were making our way towards 4,300. Then boom, bam. Markets got slammed down following, options expiration. There's some headlines regarding debt ceiling negotiations. Powell and Bernanke are speaking, and we thought we could put Bernanke in the past, but yet here he was again today. But
the subprime problem is contained.
Right, right, exactly. Still finding relevance sometime today. Maybe he'll talk about commercial real estate and how everything's contained there.
And how everything's contained.
Anyway, we've seen some volatility. Obviously, the S&P's come off the 4,200 level. What do you make of like the price action around here?
It doesn't surprise me for the most part, because look at how the market's progressed over weeks. We've seen a lot of choppiness. Moves up and then they die, breaking down, then they die. I think there's a lot of people that look at a move over 4,200. It's like, okay, sell into that move. And they got an excuse regarding the debt ceiling stuff. I think as long as the S&P ideally holds above 4,150 on a pullback and critically above 4,100, I still think there's a shot that we will see a more sustained move above 4,200. And the key here, the debt ceiling is going to come and go. And obviously there's going to be volatility around that. But Wall Street has been fixated on the idea that the economy isn't going to have a recession and the Fed's going to cut rates, which is like the perfect formula. And so I think once we get past the debt ceiling, Blake, that there's still that window of time where we'll see a move above 4,200. Maybe it's 4,250, 4,300. But my position has been, we get that rally, you do want to sell into it, because I think once the debt ceiling is over with, as we go out in coming weeks and months, it's going to be obvious that the economy is slowing. And I think that's the linchpin that has been helping Wall Street stay bullish. Hey, we don't have a recession. The data isn't weakened yet.
Yeah, Jim, I'm in the same. I'm in the sell the news camp as well. And I mean, when the debt ceiling gets raised, which undoubtedly it's going to, it doesn't really change the outlook of the economy and how it is slowing, right? And really, right. The things that you've been talking about, which I firmly believe as well, that even though the economy starts to slow with inflation above 2%, how's the Fed going to even think about cutting rates? And then also, I know we were talking just before we hit record here, that your thoughts are that the labor market continues to be strong, right?
Well, it's going to slow.
Of course,
but it's going to go slowly, okay? Because that's the last thing to happen. So we're already seeing some signs. Temporary help is declining. The number of workers for, I don't know, like the last 6 months. Well, if you're an employer, you can't find good people, you hire some temps. As soon as things slow down, you get rid of the temps. Hours worked have been declining. So the early signals are starting to appear. I just think it's later this year, second half of this year, before you'll really see any movement in the labor market. What's going to happen prior to that, obviously, is things like retail sales. We're seeing business investment begin to pull back, in part because the outlook is a little bit more cloudy. And a lot of companies, when they go to their bank to borrow money, they're having a tougher time, or the cost of borrowing has gone up so much that it starts to make some expansion plans unprofitable. So all these things take time. We talked last week about the increase in lending standards. I think it's a big deal, okay? But it's a slow motion thing, because banks raised lending standards the last 6 months. But for most companies, it isn't a problem until their loan comes due. Then it becomes an issue.
I was just thinking the first chart that you brought here, and it wasn't lending standards. You actually, because that was, I believe you talked about that last week. Yep. But this week you brought in a chart that is the leading economic index, or the LEI. Can you tell us what you're looking at here and why it's a big deal?
Well, the index is a composite of 10 separate economic data points. yield curve, housing, labor market, stock market. So it's a broad swath of indications, right? So what this shows is a 6-month kind of rate of change. And whenever, as you can see, below zero, it's what, minus 4.3 or whatever it is. Yeah, minus 4.3. And just look off to the left, going back to 1960. Other than the financial crisis and the very sharp dip we saw, because of the pandemic, we're starting to approach the lows going back the last 50, 60 years. In every single time this has happened, there's been a recession. So, I've been kind of like beating the old dead horse. The inverted yield curve, leading economic indicators, and now lending standards being wrapped up. That's like the trifecta of getting, what precedes a recession. All three are in place. Now, the second chart is why, if you will, the delay in terms of these indicators having a more pronounced impact on the economy is savings. So as we know, the government distributed several $1 trillion to consumers. At the same time, for a period of time, consumers couldn't go out. So they weren't spending other than going online and buying some goods, right? So this is from the San Francisco Fed. They estimate that at the peak, the savings got to about $2 trillion. And people have been paying or using those savings to sustain spending over the last 18 months. And what they estimate is at this point in time, we're at about $500 billion left of savings. That's the left-hand part, and that 0.5 means 500 billion. And in the first quarter, they estimate that about 85 billion a month was being drawn down from the savings pool. Well, you go out 6 months and you're going to eat up that 500 billion. So these are the reasons why I think people have kind of been misled. A lot of people jump and go, oh my God, we're in a recession in the middle of last year after 2 quarters. And then, it's going to happen before the end of the year. And now, because it hasn't happened, more and more people, well, if it hasn't happened by now, it isn't going to happen, Ali. So, anyway, my point is the dynamics are in place for a significant slowdown in the economy in the second half of this year. It's not going to happen overnight. It's going to be progressive. And the drawdown of savings is a big part of it. Consumers are 70% of GDP. We've had wage growth, increases in minimum wage in 26 states at the beginning of this year. The New York Fed came out and said between the first quarter, the 7 quarters from the second quarter of 2020 to the end of 2021, homeowners, 5 million homeowners pulled out $430 billion of home equity. And they another 9 million refinanced, and they're saving like 24 billion a year because they're paying a lower monthly mortgage payment. So these are all things that have sustained consumer spending. I just think we're getting toward the last 6 months of this year. You look at the historical lead times of the inverted yield curve, the leading economic indicators, lending standards is like 6 to 9 months. To me, all of this points to like somewhere late in the third quarter, fourth quarter, I think we're going to see a much more pronounced slowing in the economy. And the key point is the Fed isn't going to immediately cut rates. Powell has said the bigger mistake would be cutting prematurely. They don't, they want to give, if you will, the economy time to slow enough and stay slow long enough to really bring inflation down. So one other point, we're going to see again, and I've been talking about this since last October, a big decline in the consumer price index. In the next 2 months, Blake, from May of last year and June of last year, 97 basis points are going to get subtracted when we get the next CPI. And then for June, it's 123, I think, or 132. So in other words, the takeaway values from last year for May and June is like, 2.4%. Well, if the current CPI is at 0.4, which it may not be, we're only going to add 0.8. So that means 1.6 from 4.9, potentially by mid-June or July, when this June CPI comes out, the CPI is going to be under 3.5. So again, Wall Street has, kind of gone crazy. Oh, the CPI is coming down. That'll give the Fed wiggle room. And as we've talked, the key thing here is the labor market. And I think I had, charts last week showing, the unemployment rate is at 3.5. The natural rate of, if you will, the equilibrium point in the labor market that the Fed determines is at 4.4. So again, it just comes down to when are we going to start seeing enough data points showing that the economy is slowing meaningfully, and that I think is going to have the greatest impact on the stock market.
All right. Well, we've seen it impact a lot of the markets this week, predominantly in the dollar, and we've seen the dollar continue to pick up steam. I know you've been really over the last few weeks watching the 101.80 level, 101.50 level.
Yeah,
that's managed to hold in the dollar index. Looks like we're ramping up to maybe trade up towards what you have as a C here. And I just want to allow or also alert everybody else, if you're looking at a dollar index on a daily chart, and you have your,
and this is the cash index.
Yeah. But if you look at the cash index or even the dollar index, the 200-day moving average comes in right around that level too. Just FYI, just for those of you that are following along with your charts. So how do you think the dollar is going to react here? Because the dollar was really unloved a couple of weeks ago, but here we are. The dollar's starting to scrape some of these losses back. What do you think?
Well, again, I think the decline, that wave A marked down to the low of B, was right when this regional bank crisis hit. People started to, maybe the Fed won't even raise the funds rate at the May meeting, but they're going to be cutting in the second half of this year. And I think that is just a false premise. And the economic data was still going to be okay enough to maybe make people start to question that. But more importantly, I think, and we've seen this, all the Fed speakers, they're also, there's no one talking about cutting rates. The debate is, well, are we going to move one more time in June or not? And, they're data dependent, so they don't know. But my point is that the outlook that I think currency traders had, that the Fed would be caving in because of the regional banking crisis, that's just not playing out. So chart pattern, I just think that potentially you got a wave A up, a B wave pullback, you kind of have a double bottom, and we get a C wave that goes up near the high of the wave A, which is 105.88. And, after that, I think potentially we will see a much larger decline in the dollar. Just in the short term, I think, the dollar looks like it has legs. The other thing is the European economy for months was stronger than expected because energy prices in the fourth quarter and the first quarter came down significantly. There was more than enough natural gas. And so the economy was stronger than expected. I think we're starting to see signs that strength is waning. At the same time, the ECB is talking about raising rates. So we talked about this last week. To me, the rally late last week was significant because it was in the face of the ECB talking about more rate hikes, the Bank of England talking about more rate hikes, and the potential that the Fed is actually getting close to the pause button. So adding it all together, I just think the odds favored that we were going to see a rally in the dollar once it got over 102.25, that had been intraday highs on several occasions. That was like, okay, the trend is up now, and now it's a question of, what kind of follow through. Chart suggests 105.88 is likely.
All right. Well, that's had a negative impact on gold. We've finally seen gold crack under some of this pressure from the dollar, broke through a little bit of support. So what are your thoughts on gold here?
Haven't changed. As you know, over the last 3 to 4 or 5 weeks, my expectation was that as the dollar started to strengthen, we would see gold pull back. Technically, gold had a 1, 2, 3, 4, 5 rally. Hey, that's bullish longer term. But that it means that 5 up means you completed something. And in my take, that 5 up is wave 1 on the way to higher all-time highs. But wave 2 is going to retrace some portion of that initial rally up. And so now it's just a question of, okay, how much damage will dollar strength cause? Plus, there was a fair amount of bullishness that had ramped up into the gold market after that move up. And I think some of that gets unwound. So, the 1920 number seems reasonable. And the 382 retracement of the rally from last September's low to the high recently is, I think, about 1890.
Ironically, Jim, and this is the anecdotal evidence sometimes you pull around from different things. My neighbor, one of my neighbors is a chiropractor. I saw him in the gym yesterday, and he actually pulled me aside. And he said, "Hey, I'm interested in buying some gold." And the guy, and the second thing out of his mouth was, "I don't know, I don't know anything about this stuff," and that was all the information I needed, Jim. I'm like, okay, see you later.
Yeah.
I didn't even manage to answer his questions.
At least he was honest about it, and
the other
thing is he thought that you knew more than he did, so that's a good thing.
Anyway, but it does look like we're going to see a little bit of a pullback here, and as you're pointing out, is how far will the pullback
how deep is it?
And I just want to make sure that we're clear here. Everybody needs to hear the part that Jim does believe that we will be making new highs in gold. It's just how far is this pullback going to be before we do that?
It's a buying opportunity.
Great.
That's all.
Okay.
So.
Sounds good. All right. So the next chart you brought is the bond market. Now, bonds are coming down. You thought the bonds were going to go up, and yet they are going down. So has it changed your view and your count here?
Well, we're close. Stop at 101.35. It traded under that this morning. Right before we started our conversation, it was a little bit above that. I still think that, short term, if I get stopped out of this trade, I'm going to be looking to be a buyer. Because, again, my fundamental view is that the economy is going to slow more significantly in coming months. We are going to see inflation continue to wind down. Even some of the core measures that have been boosted in the last 6 months by the shelter component, Blake, because of the way they do those calculations, they have a real long lag effect. Well, we know what's happened to apartment rents, housing prices coming down. What's going to happen in the next 2, 3, 4 months is slowly but surely that data is going to bleed through into the delayed core CPI data and some of the other core measures. So even the core CPI and core other measures of inflation are going to start to tick lower. So again, I think now here's an interesting thing. And I think the reason why the bond market's been a little bit weaker is the idea that, hey, the Fed may have to raise rates more. If they do solve the debt ceiling issue, that's going to be good for the economy and so forth. So we kind of have to work through some of this stuff. But I'm looking to a place, if I get stopped out, I'm still going to be looking for a place to go long, because I think as we go into later this year, TLT is going to make a move above 110, and that targets up towards 115, 117. And the other thing is there is a huge short position across the Treasury curve. So again, I think if strength will beget short covering. So we'll see.
We'll see. And Jim, I know you're an old school chart technician. I know you're looking at TLT, but if you look at the 10-year bonds, the ZNs that trade on the futures, and you look at the continuous contract, we actually had what we call a golden cross, where the 50-day crosses over the 200-day moving average. Although as soon as we did that, we've actually come down since then. But there's actually this golden cross on the daily charts for those of you that follow, some traditional technical analysis. Just little heads up. Let's look at the S&P. So here's your S&P trying to break out. We were looking like it was going to happen today. We were a little slightly below this 4,200 level at this point because of some tape bombs that hit the market. But overall, what are your thoughts here about stocks?
I still think the odds are that we're going to see a move above 4,200 that sustains itself for a little bit. But what you can see short term at the bottom is the MACD on the RSI, which is an indicator that I kind of created, and you can see it's overbought. And you look to the left, you can see all the other times when it got overbought, very much coincided with short-term highs. Some of those highs turned out to be pretty meaningful. My take here is at a minimum, the S&P has to hold above 4,100. That sideways action that we did for 2 weeks or whatever it was, bouncing around just above 4,100. We shouldn't take that out. Ideally, it holds above 4140, 4150, which is kind of like the highs, during that sideways period. I do think that the debt ceiling is going to get resolved one way or the other. And, that's going to generate a move above 4,200. There are a fair amount of shorts. Some people have been hedging positions, not knowing what's going to happen with the debt ceiling. So I just think that if you can get the move above 4,200 that sustains, you're going to get a spike in bullishness. Technicians are going to say, hey, we got a breakout. And the fundamentalists are going to say, yep, the stock market's telling me we're not going to have a recession. Well, to me, that's the perfect setup, because to me, the indicators that I've talked about for weeks and weeks in terms of their long-term message of big slowdowns coming in the second half of this year, so to me, you get a big spike in enthusiasm is the perfect setup before we reverse lower. And I still think the probabilities favor a retest of the October low if the economy slows as much as I think it's likely to do.
So you still think that we can, sell into strength and eventually look for a move that it heads a lot lower in the months ahead?
Yes, because what's really been underpinning the market, Blake, is the idea that the economy isn't going to go into recession. Wall Street pegs earnings to be up 11% this year. And the idea that the Fed's going to cut rates, to me is just ludicrous, but that's part of the bullish scenario. If you think the Fed's only variable is inflation, well, it's going to continue to come down. Why wouldn't the Fed cut rates? Well, because the unemployment rate is at 54-year low. And, that tightness is a longer-term problem. From the Fed's point of view, wage growth has to slow from the 5% range that it's been at and getting down closer to 3% annual rate. The Fed's comfortable with 3%. That is compatible with a 2% inflation target, if you go back to the last 20 years. So I just don't think that the Fed is going to cave in just because inflation. I think they're going to maintain, as they have said, getting the funds rate up to a high level, 5.1. I'm kind of in the camp that I would be surprised if they increase any more times. But whatever they're doing, I just don't think they're cutting anytime soon. And as the impact from all the things, rate increases, tightening of lending standards, the economy is going to slow. And once it starts slowing, it starts to feed on itself. Once we really do see the unemployment rate tick up 1, 2, 3 tenths, all of a sudden, what are the headlines going to be? Especially if the unemployment gets up to 4%, what are the headlines going to be? And people are going to naturally pull back. I mean, that's what happens in all these business cycles. So to me, nothing is happening that hasn't happened many times before. It's just kind of been stretched out because of all the excess savings and all the other things that have gone in to support incomes.
I like to make sure that I mention this, especially for our non-US viewers. If the United States is really made up of so many small businesses, I forget what the exact number is that really drive the US economy, but it's an overwhelming majority. And maybe some of you could jump in the comment section down below. When you're a small business owner, and we have so many of them here in the U.S. that own small to medium-sized businesses, whether they have
under 5 employees,
5 employees to 500 employees, they've got employees. These guys and gals that run these businesses, they're not idiots. But I mean, for the most part, there are. You met some, I've met some, but for the most part,
small business and survive.
Yeah,
you've got to be pretty darn good.
You do have to be. You have to be pretty good, pretty smart, and you're paying attention to what's happening around you, not only in your own industry, but what's happening globally and what's happening in your economy, in the U.S. economy. So when Jim talks about the idea that this negative feedback loop that you might get if unemployment starts to tick up, if I'm a business, well, I am a small business owner, but if I was one that had some sort of, whether it's a restaurant or manufacturing company, small, whatever it is, and I start to see unemployment tick up, I'm going to think twice about hiring somebody new. And I'm going to think about spending some of that extra money on some of the costs some things that maybe my business need. So those are really important aspects that I think you as traders and investors in the U.S. economy, you trade around these whether it's the bond market or dollars or the futures, whatever it is, it's really important that you keep in mind those types of things as the economy continues to move forward.
Well, that's why lending standards are so important. And it's something that really, for the most part, no one pays attention to. I mean, as you know, I started writing about this last November, way before, people's attention got aroused. But the key thing, as you say, for international traders is that, the big companies can go to the credit market and borrow money. They are not as dependent on the banking system for credit. Small to mid-sized businesses are almost exclusively dependent on banks. So that when we see the problems we're seeing with the regional banks and the increase in lending standards, that for a lot of small businesses is going to be unduly hard for them to get the money they need. Or the other thing that's happening is the Fed's raised the funds rate 500 basis points. The prime rate's gone up 500 basis points. A lot of the loans to small and medium-sized businesses are prime plus a spread. And now what banks are doing is increasing that spread because they perceive there's an economic risk out there. So for a lot of small businesses, when those loans come due, you go from whatever your rate was, 4% to 9% to 10% or whatever the number is. That's a big drag on cash flow. And so that's what's going to happen, but it evolves over time. So that's why I've been making a big deal about the lending standards.
Yeah,
because it really gets to Main Street as opposed to Wall Street.
It's a great point, Jim, and I'm glad that we talk about this every week. So, Jim, how do I follow your work? If I don't do it, if I'm only hearing you on the Traders Summit show and the show that we have every week, how do I follow your work closer?
Macrotides.com. If you want to get a recent publication, send me an email, jimwelshmacro@gmail, and I'll send you out the recent weekly technical review. And I think you'll see the detail that, we cover a lot of stuff. I love doing this with you, Blake, because we do cover a lot of ground. And I think for a lot of the trading community, they're technically oriented, which they have to be. But to me, the best thing is to integrate fundamental analysis with technical analysis. And at the times you can do that, at least for me, my conviction level is much, much higher. So hopefully we're helping people, move toward that goal.
And if Jim helps you do that, make sure you give him a big thumbs up. Subscribe to the channel down below so you don't miss any of this content that we do exclusively here on Trader Summit. Jim, thank you so much for joining us this week. I'll look forward to speaking to you next Friday.
You got it, buddy. Take care.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.